Welcome everyone to another explainer. I am so incredibly thrilled you're here with me today because, well, we're looking at a financial crossroads that almost every single one of us has faced, or absolutely will face, at some point in our lives. We're going to visually break down one of the most common, yet kind of most misunderstood wealth-building traps out there. Today's explainer is all about the 30% APR versus 8% return math fail. This is where human psychology and raw, hard mathematics just collide. We're going to untangle the whole shebang step by step so you know exactly how to keep more of your hard-earned money.
Okay, let's dive into this. Section 1. The Great Money Dilemma. We've all been here, right? You've been working hard, maybe budgeting a little better lately, and suddenly, boom, you find yourself with a bit of a surplus. It's a great feeling. But then, that feeling of accomplishment is almost instantly replaced by a wave of anxiety. You know, what is the absolute best, mathematically optimal thing you should do with that extra cash? Do you use it to build your future, or do you use it to clean up your past? Let's say you have a spare $1,000. Should you invest it, or should you pay off your credit card balance? It sounds like a super simple question, doesn't it? On one hand, you've got all the financial gurus on social media raving about the magic of compounding interest in the stock market. But on the other hand, you've got this nagging credit card balance that's been hanging around since last year's holiday shopping. So, which one actually wins?
Well, let's meet the players. Section 2, the contenders, 8% versus 30%.
Before we pit them against each other, we need to make sure we're all on exactly the same page with our vocabulary. APR. It stands for annual percentage rate. To put it in plain, everyday terms, this is the yearly cost of carrying a balance on your debt. It's basically what the bank charges you for the privilege of renting their money. And the really tricky thing about credit card APRs? They calculate daily. Every single day you hold that balance, a tiny fraction of that massive yearly percentage is tacked on to what you owe, slowly but surely inflating your debt.
Now check out this stark contrast. We have an 8% return. This represents the historical inflation-adjusted average return of the broader stock market. Think of an S&P 500 index fund over the long haul. It's pretty much the gold standard for building long-term wealth. But on the flip side, we have a 30% APR. And let's be real here. With recent interest rate hikes, seeing credit card APRs sitting at 25, 28, or even 30% is incredibly common. So you have a slow, steady 8% engine trying to push you forward, fighting against a massive 30% anchor, literally dragging you backward.
Now, what's really interesting about this slide is Section 3, unpacking the math fail.
Even knowing those numbers, so many of us still try to do both. We think, hey, if I just pay the minimum on the credit card, I can start investing and let the market do its magic. We kind of think we can outsmart the system. But trying to do both simultaneously, it's a massive trap. We call it the math fail. The human brain actually really struggles to conceptualize compounding interest in percentages because we see investing as a positive action. We completely overestimate its impact. But visually, the mismatch is insane. A tiny 8% gain is completely overshadowed by a towering, imposing 30% loss to the credit card company. Trying to build wealth at 8% while bleeding wealth at 30%, it's literally like trying to bail out a sinking rowboat with a tiny teacup while a fire hose is blasting water right back into the hull. No way you win that.
Let's ground this in actual cold, hard dollars so we can see the exact math fail in action. Let's say January 1st rolls around. You've got your $1,000 extra cash. You also have a $1,000 balance on your credit card. You decide to be an investor. You put that $1,000 into an index fund. After 1 year, congratulations, you gained 8%. You made a cool $80. But wait, you left that other $1,000 sitting on your credit card at a 30% APR. Over that same exact year, the credit card company charged you $300 in interest. So, actually, scratch the celebration. You made $80, but you paid out $300. You are mathematically $220 poorer than when you started, all while feeling like you made this super responsible investing decision.
Let this concept just absolutely burn into your memory. You cannot out-earn a 30% interest rate with an 8% yield. It is mathematically impossible. Holding high APR consumer debt while simultaneously trying to invest in the stock market is a financial failure that quietly drains your money month after month. Every dollar you put into the market is working less than a third as hard as the dollar actively working against you on your credit card statement.
Let's move to and see how this builds. Section 4, your winning financial strategy.
What if I told you that there is an investment out there that offers a guaranteed, risk-free, tax-free 30% return on your money? Seriously, Wall Street hedge fund managers would literally trample each other to get access to a guaranteed 30% return. It doesn't exist in the stock market, but it exists in your wallet right now.
When you take your extra cash and pay down a credit card that charges you 30% APR, you are instantly locking in a 30% return by avoiding that exact loss.
So here is your actionable 3-step playbook to fix the math fail. Step 1, stop investing temporarily. Yes, I know it hurts, but pause the stock market dreams for just a minute. Step 2, take every extra dollar and crush that 30% debt. Just destroy it. Because as we saw, killing that debt is your absolute highest yielding investment. And finally, step 3, once that high interest debt is gone, you take all that freed up cash flow, the money that used to go straight to bank interest, and you redirect it with full force into those 8% market returns. Now your money is finally moving in one direction, up.
So, the crucial point is this. Paying off high interest debt is the highest guaranteed return on your money. It's a total paradigm shift. You have to stop viewing debt payoff as some sort of punishment for past mistakes and start viewing it as the most aggressive, most lucrative investment decision you can possibly make today.
And that brings us to the end of our breakdown. Now that you've seen the math fail and you understand the guaranteed power of eliminating those high APRs, what is the very next move you're going to make with your extra cash? Don't let your money just leak out of the bucket. Take control of the math. Thanks so much for joining me for this explainer, and I will see you all next time.